Okay, so this is week 6, Financial Foundations Part 3, the third and final part of Financial Foundations that you'll need going into FP&A. Once again, only about 6 to 7 slides, I would say max. So going off of the concept of risk and return that we briefly touched upon at the end of last week, the two are positively correlated, which means as risk increases within any investment or anything at all intuitively, so should the equivalent return. If you're taking additional risk as an investor within a project, you expect an increased return. Otherwise, it's not worth it for you to enter that agreement or invest in that project that has more risk than any other project. You expect higher relative returns. So, you might be asking, like, the concept of risk and return, sure, it's positively correlated, but how do we quantify that? It's very abstract up until now, but there are certain ways to quantify it. Now, this is a very reduced version. This is very, very foundational in the world of finance. It gets way, way, way more complex because this holds a bunch of other external environmental factors, ceteris paribus, or all other things set equal. But that's not the case. Factors are moving around all the time. But this is the first step towards building those more complex models. And this is where you kind of start learning about how to quantify risk and how to quantify return within the market. So the best, most easiest way to do this that you will either have learned or will learn in finance is CAPM, or the Capital Asset Pricing Model. The CAPM model is repetitive. It's just CAPM because the word model is already included in CAPM. But what it measures is it measures returns given the input of risk. And how it does this is it takes the risk-free market return. This usually is the return of a 10-year treasury bill, or a T-bill, as you might say, because there's absolutely no risk in a T-bill. It's the least risky asset because it's backed by the US government, which is the most strong backer of any legal tender in the entire world. It's the world's reserve currency. It's the strongest currency in the world. Might not be the most valuable in terms of notional exchange rates, but it's the strongest simply because it's backed by the US government. Taking that into account, treasury bills that are backed by the US government's Treasury Department will theoretically and technically be the most risk-free asset in the world, and especially in the US, because that's what we really care about. So the risk-free market rate is the absolute bare minimum rate that you can get without taking absolutely any risks whatsoever. Now, understandably, this rate is going to be low because if you're taking no risk, you might not get zero returns. Like it's a straight line, almost risk versus return, but it doesn't start at zero. It'll usually start at about 1, 2, maybe a little bit higher in an inflationary period percent. Like right now, the risk-free rate, I'd say, is about 2.5%, 2.48%, because that's how much the 10-year treasury bill is yielding right now because of high inflation. So it's not going to be zero, but it's going to be pretty low because you're not taking any risk. So you take that, that's the RF in this equation. RI is CAPM, or the expected return. This beta over here is how correlated or volatile this project or investment is compared to the overall market. And this basically measures how responsive this investment is to the overall market. For overall market, you can think of the S&P 500 pretty much. If you're talking about a publicly traded company, for example, when the S&P goes up, or when the overall stock market goes up 5%, what is this stock or investment doing? Is it going up? Is it going down? If it goes down, that means the beta is negative, which means this project is negatively correlated with the market. If it's positive, then it is positively correlated with the market. However, there's a problem sometimes because if the beta is too high or above a 1, that means for every 1%, let's say the beta is 1.5. That means for every 1% the market goes up, the beta will go up by 1.5%. Or sorry, the returns of the project will go up 1.5% because the beta is 1.5. For every 1% market increase, this project's returns goes up 1.5. However, this is a problem because inversely, if the market goes down 1%, then this project's expected return will also go down 1.5%. So it's it's a double-edged sword. You have higher than market returns on a good day, and you have much lower than market losses, much worse losses than market losses on any given day. So it's a double-edged sword. Usually what you'd want is a beta that's between 0 and 1. So it's not totally uncorrelated, but it's not totally correlated or too highly correlated. So if the market moves, then it doesn't move as much. You're insulated from that market risk a little bit. If it goes down, then your returns will also go down, but not as much as the market. And the risk for that, or the trade-off, is that when the market is up, then your returns from this project are not going to be as high, but they're also not going to be as bad on a down day. So it's always about these trade-offs. Are you willing to accept a lower return on a good day in order to accept or be happy with a lower loss on a bad day? Or are you willing to accept a worse than market loss on a bad day in order to get a much better than market return on a good day? So that's basically what beta measures, how responsive or correlated or volatile a project or investment is compared to the overall market. And then finally, you have the expected return of the overall market. So that is RM. So expected return of the market, or market return, is RM. This is how much investors expect the market to return. And usually, and not usually, all the time, pretty much, this RM is going to be higher than the RF, because for RF, you're not taking any risks, whereas for RM, you are taking risks, because the market could go down just as easily as it has gone up, because there are equities, there are bonds, there are many different players. You know, there are external economic conditions that could affect the price of a stock or a bond, and as a result, there is risk with expected return of the market. That RM minus RF in the parentheses is super important. I'm going to annotate that. Okay, so that RM minus RF, so that is basically the difference between the expected return of the market and the risk-free return, the return you get not taking any risk, or a 10-year T-bill. That is called the market. I'm going to try to write this as legibly as possible. Market risk premium. So essentially, inside this parentheses is how much extra you're paying in order to accept the risk of the market. So if RM is 8% and RF is 2%, your MRP, or market risk premium, is going to be 6%. And that is how much extra in returns you are getting for accepting the potential volatility of the market. That's what this thing in parentheses means. And of course, it's going to be multiplied by the beta when you have to take into account how volatile the investment is compared to the overall market. And then you add that to the risk-free rate, because that's your benchmark. It cannot go lower than that. Now, there's a very, very low but still existent chance that this number over here, without the RF, is lower than the RF, but we don't want that, because RF is the bare minimum that we can get in the market. That's why we always have to add it to the market risk premium times the beta. So that's CAPM in a nutshell. And I'll go into the other uses of CAPM in the upcoming slides as well. So I mentioned earlier, risk and return are positively correlated in the world of finance, very important. More risk equals more return. More risk you take, the greater the potential return you can achieve. The goal of financial planning and investment is to maximize returns while minimizing risk. So your goal is to try and get as much returns as possible while not being exposed to the litany of risks that are apparent in the market. So I know it's a little counterintuitive, but that's the goal. Knowing that risk and return are positively correlated, how do you lower risk while increasing return? So you have to do a lot of hedging and a lot of financial mathematics and planning. A lot of it just comes down to brass tacks. When it comes down to brass tacks, it's all about planning, financial and non-financial alike. We can thus use the expected return on an investment as a measure of cost of equity. So this is what I was talking about in terms of how to use CAPM, and I'll go into that in the next slides. CAPM can also be thought as cost of equity, or how much your investors expect from you. And as most of you may know, hopefully, Equity is ownership in a company. So when people invest into your company, that investment is equity. They're giving you money because they're expecting a return. They're providing input into the company. They're giving you that money because they think it's going to increase in value, and they think that they can realize capital gains from the project. Therefore, they are equity holders. And the CAPM formula is essentially the cost of equity in that way, because it's what investors expect. It is your cost of having them on board, because you have to pay them that rate at minimum. You know, the CAPM formula could yield 7%, 8%. That means your investors expect you to make 7 to 8% for them every year. But that's cost of equity, because that's your outflows. That's how much you have to return for your investors in order to keep them happy, and in order to make them either invest more into your company, or just to keep them around and not to pull their money out, in which case, in most cases, your business will go under. So going off of that, cost of equity is how much a company must pay back to its investors, source of equity, for their investment, often in the form of a percentage return. That's what I was talking about when I said 8% return. The CAPM formula might give you back that kind of percentage, and you have to use that as the cost of equity. So this is to compensate for the risk investors undertake when investing in the project or company. There's always risk, right, guys? There's always risk apparent in the market. When you're running a project, there is a pretty high sometimes chance, no matter how affluent you may be, no matter how much funding you initially have, no matter how rich your parents are, if you're starting a business, there's a good chance it'll fail. That's always a risk. When people invest into you, there is a chance that that company that you're running goes down to zero. And so investors want to be protected against that. They want a solid business strategy, a solid business idea, and good management and leadership. And then and only then will they invest, as long as they can be promised a decent return that makes sense, that can be consistent, that can be defended by management. Right? So that's where the cost of equity comes from. It's like, hey, I'm investing in you, I believe in you, but I'm going to need 8% on this. Otherwise, I'm pulling my money out, because it doesn't serve me well to keep investing in your company if I get anything less than that. Right? Like I said, cost of equity, you can think of it as CAPM. Cost of debt, on the other hand, is how much it costs a company to maintain its debt. This is calculated by dividing interest expense by total debt obligations. So if you have like $1,000 in total long-term and short-term debt, that's your denominator. And if your interest rate on that is 5%, 5% of 1,000 is $50. So you have to pay $50 average on interest, right? That 5% that I said, that 5% interest rate, that's the cost of debt, because that's how much you are paying your debt holders now, not equity. Equity is people that own a stake in your company. Debt is just people that are giving you money and they want interest and principal back. They have no input in the company. They're not owners of the company at all. They're just debt holders. They've given you money and they want that money back at a later date and more in the form of interest payments. That's it. No other input, no voting, no board seats, no equity, nothing like that. It's just, I give you money, I want more money back after a certain number of years. And you get that percentage by calculating the interest rate or doing interest expense divided by total debt obligations. And accrued interest is a direct cost of holding onto debt for a long period of time. So the longer you have debt, the more your interest will be, and hence a high cost of debt is important to a company's capital structure. How much, in the cost of debt and cost of equity equals debt and equity, I should say, equals a company's assets, which is essentially a company's total value. And as I was saying, the percentage of debt and percentage of equity, not just equity, the percentage of equity. So cost of equity and cost of debt combined with the percentage of each, it could be 60-40, 70-30, has to equal 100, because your assets are funded by either debt or equity. We went over this before. It's not funded by anything else. It's made up of debt and equity. How much of each? That's up to you as a business owner. So percentage of debt and equity multiplied by cost of equity and debt respectively, that's known as a firm's capital structure. And a firm's capital structure is essentially how much debt and equity a company holds, and what is the cost of equity and debt, respectively, for that company, right? How much does it have to return to its debt holders, and how much does it have to return to its investors or stakeholders in the form of cost of equity? That combined is a company's capital structure. So these two metrics are used to calculate, and this is the big equation for finance, the weighted average cost of capital, or WACC for short. And you'll be hearing a lot of this later on in your finance classes if you haven't already, especially in financial management. This is probably the most important topic you'll learn. Now, just to wrap things up, I believe these are the last 2 or 3 slides. WACC, or weighted average cost of capital, I'm just going to call it WACC from now on, is a measure of how much your capital, in this case debt and equity, and in every case, will cost you on a yearly basis for an investment or project to finance your assets. This is also known as, if you've heard of discount rate anywhere, in order to discount your cash flows, or DCFs, discounted cash flows for any company, the rate that you discounted by is usually the weighted average cost of capital. Sometimes it could be the inflation rate. Usually it's the weighted average cost of capital, especially when you're talking about a firm's projects or investments, because the weighted average cost of capital is a measure of how much debt and equity a company has. So it directly measures how much a company is giving back to their debt and equity holders. Thus, they have to reduce that from their future cash flow projections. That's where you get DCFs from, or discounted cash flows. When you present value those cash flows, or bring back future cash flow values to what it would be worth today, you do it using the WACC. And that's super important because, when I was taking finance classes early on, I would always say, where do they get these, discount rate numbers from? Do they just come out of it with thin air? It's 5%, 6%, 7%, 8%. But in most cases, you use the WACC and you use this formula. Once again, it's a little, obviously, it's very intuitive, but it's a little simplistic. But it's the first step towards coming up with more complex methods to calculate weighted average cost of capital and overall hurdle rates, discount rates, stuff like that. Pretty much the same thing. So this is a start. Let me annotate this as well as important. Okay, WACC, weighted average cost of capital. This part over here, so it's E over E plus D, which is shareholders' equity, over equity plus debt, which is just, E equal to total assets, which is a company's total value. So this part over here represents percent equity. It's how much equity a company has compared to their total capital structure. Now, intuitively, this would mean percent debt, because now we have the debt number on the numerator. This is measuring what percent of our capital structure is debt. We multiply our percent equity by the cost of equity. RE is the same as return on equity, right? And as stated below, and as I've said previously, same as your CAPM formula. Your RE is just your CAPM formula. You take your risk-free rate, you add it to your beta times market risk premium. That is what your cost of equity is. And you multiply that by whatever percent equity makes up in your company's capital structure. Now for debt, you do percent debt times cost of debt, which is just interest rate pretty much, or the weighted average interest rate. So if you have multiple loans, then you have to do each loan amount multiplied by its effective annual interest rate, and then weight it based on what percent of your total debt that makes up. And that's your cost of debt, essentially. So it's your overall interest rate percentage. And the important thing here, I'll talk about this in the next slide as well, is tax. So you always multiply your debt mechanisms, not equity. Notice the plus sign here. This tax rate has nothing to do with equity. It has everything to do with debt. And I'll talk about that in the next slide as to why that's the case. You multiply percent debt times return on debt. You're not done there, or cost of debt, I should say. You multiply those two by 1 minus the tax rate. You always have to do that. Has nothing to do with equity and everything to do with debt. So remember that when we go over the next slide. Why is that the case? Why are we taking into account the tax rate for debt, but not for equity? And why are we taking into account the tax rate at all? Okay, pretty simple explanation. Actually, before I get to that, why is capital structure important? The percent of debt and equity your company holds, super important. It's important for accomplishing key financial goals and objectives in the short and long. And it can also be indicative of what kind of industry you're in. You know, banks, for example, hold over 80% debt because that is the only way to maintain their balance sheet without requiring people pay extra, or without having to return high rates of equity, pretty much, because they would have to borrow money at insanely high rates if they kept their leverage ratio any lower than 80%. Now, if banks held like less than 80% of their total assets in debt, then that's a problem because their ROE has to be much higher than it needs to be, and all of a sudden they have to borrow money at insanely high rates. But I'm getting into more complex topics. But I'm just saying banks have to keep very high levels of debt. That's fine. Sometimes you hear high debt, 80% debt, you think game over. This company is going to go under because of all the interest they have to pay. Not necessarily. For banks, that's normal. For tech companies, though, you don't want to have too much debt. You want to pay off your debt and you want to hold a lot of equity like Apple has been doing. They've been paying off their debt periodically, and they've always had a good amount of equity because they don't want to pay too much in interest and they don't want to be over leveraged given the industry that they're in. The tech industry can be volatile. Even for Apple, I think they're $1 trillion company now, I believe, for the past couple of years. Even for a company as big as theirs, they always face these regulatory roadblocks. They always face competition within the tech industry that's burgeoning and that's just, being disruptive in all different fields. The cash flows for them in the future are very uncertain because they could go down precipitously in a moment's notice. That has happened with HTC, for example. So when that kind of thing happens, you don't want your net income to have, but your interest expense to go up because you have a whole lot of debt, right? That's a problem. So in that case, having a lot of debt is bad. So knowing your capital structure as a company can give an indication of what industry your company is in, and you can look at it relative to other companies in your industry. Is my debt too high compared to my competitors? Is it too low? Is that a good thing or a bad thing? That's totally up for interpretation. That's why it's important. As well as what your return on debt and your return on equity is. Is one too much higher than the other? How do we level that a little bit? How do we apply a higher multiple on ROE as opposed to ROD, or RE and RD, I should say. Generally, companies hold more leverage than equity as a way to magnify returns using borrowed money. Now, this is dangerous, obviously, because if you have a lot of debt, the general rule is that debt makes the good times better and the bad times worse. This is a very important lesson you'll learn in corporate finance. And it's something that I learned in my advanced corporate finance class. Debt isn't always bad. In fact, if a company accrues a lot of debt, issues bonds or gets a lot of money as debt in one time, investors think that's generally a good thing. Because unless the company is going under, that means that they can grow using that debt and magnify their returns and then pay it off using a slight portion of the returns they'll get using that debt. Now, debt makes the good times better. If I only have $100 to invest, what if I borrow another 100? All of a sudden, I have 200 and put it in the same stock, and that stock goes up 10%. What's 10% of 200? It's $20. So by borrowing that extra $100, I've now made an extra $10 because if I invested $100 in that stock, I would have only gotten $10 at a 10% return. If I borrow another 100, then I get a $20 return at 10%. So that's an extra $10 that I made with somebody else's money. And if the interest rate is less than 10%, then that's really good because I keep the difference of that profit, as profit. So that's why leverage can be good. However, if the market goes down, then all of a sudden I have to pay interest on what I paid for that stock, and I have to take the L. I basically have to take the loss on the stock. So debt makes the good times better, and it makes the bad times worse. You can use it as borrowed money to magnify returns. However, during recessions, and this happens all the time, this is why a lot of companies go bust during big recessions, especially during COVID. If you have too much debt, you are going to experience losses much larger than if you had not accrued debt at all. And you have to pay interest on it. So that's a disaster scene. All right. So that's why cap stack is important. You need to understand how much debt and equity your company can hold in order to maintain a sustainable growth rate and a sustainable company strategy. You don't want to hold too much debt. You don't want to hold too little debt because you want to get higher returns. Sometimes debt is good. It's helpful. You know, John Deere, very, very famous tractor company, you know, I'm sure all of you have heard of them, but you haven't heard of other companies like Massey Ferguson because they ran them out of business using debt. They took advantage of a downturn, right? Where other companies, you know, they leveraged up too much. And then during a high inflation recessionary period during the 70s, those companies started losing money like crazy. They had extremely high interest expenses because they accrued a ton of debt, and John Deere didn't. Then, when those companies were fledgling, John Deere took up a bunch of debt, a ton of debt, at a very low cost, invested it in the right way while those companies were down, and completely ran those companies out of business. And now they're probably the premier tractor producer in the entire world. They have most of the market share, and they have insanely good brand recognition. I'm pretty sure most of you have heard of John Deere. So in that sense, debt can be good in capturing more market share and winning out in the world of finance, you know? So don't think of debt as always a bad thing. But once again, cap stack is important in determining debt and equity in that regard. Finally, we'll get into taxes. So I think I went on a bit of a tangent there. Well, not tangent, but I did kind of go away from the concept of taxes a little bit, tying it all back together in terms of taxes. That's the last aspect of WACC. So why is this important? The main reason and the only reason it's important, tax acts as a shield for your WACC. It reduces your WACC. That's good. Why it does this is because interest payments, or you know, the numerator on return on debt, on certain debts are tax deductible, which means you don't have to pay taxes on them. So only part of your cost of debt is left after tax. Like, oh, sorry, only the part of your cost of debt that is left after tax will be considered in WACC. So you only essentially have to pay tax on what's, you only have to pay returns of what is left after taxes in order for it to be considered in your WACC. I know it's slightly confusing, but essentially taxes help you because that 1 minus t, you know, as long as that t is positive, which it always will be, there's no such thing as a negative tax rate, your WACC will be lower because your overall debt percentage will be lower. Return on debt times debt percentage times 1 minus tax, right? Because in that sense, tax acts as a shield. It reduces your WACC. And when WACC goes down, that's good as the owner of a company or as the owner of a project. Because now, instead of my investors expecting 8% returns from me, they can only expect about 7 or 6% returns, depending on what the tax rate is, because it acts as a shield. Because they understand that taxes are going to have an impact on debt, and you know they can't expect returns as high pre-tax because you know we live in a world with taxes. Therefore, tax is good. You know, you want it to be a part. You want tax to act as a shield for you in this case. And the higher the tax, the better it is for your WACC. Although it will mess up your net income because you're going to have to give away more of your operating income to taxes, so that will lower your net income. But it will also lower the WACC, so it all balances out. When tax rates go high, net income levels aren't the only things that decrease, so do the expectations of returns by investors. So it all balances out. All right, so that is the presentation. Said it was going to be short. I think we went to about 35 minutes today. So I'm going to stop sharing screen. I'm glad it ended relatively quickly. I'm going to stop recording.